Hi. Financial planning and analysis is at the heart of strategic business decision making, driving clarity and precision through its core deliverables. These include the monthly management reporting, quarterly forecasting, annual budgeting, 5-year planning, what-if analysis, scenario planning, and transformation impact analysis. While some companies employ different softwares for each task, best practices show that integrating these functions into one single efficient tool enhances accuracy and efficiency. Microsoft Excel, a tried and tested cornerstone in the FP&A space, continues to lead the way. With advancements like Power Query and Copilot, Excel remains the go-to platform for building fully integrated dynamic financial models. It offers the flexibility, scalability, and precision required to consolidate complex data into actionable insights, making it indispensable for delivering impactful financial planning and analysis. This is the latest version of our Nested suite of fully integrated financial model presentation. It is deserving, therefore, to have the anatomy of the company and the power of these financial models. And let's start by going back to remind ourselves that every company starts with an idea, a solution to a problem, whether it is a neighborhood corner shop or a sprawling multinational corporation. The principle is the same. It identifies a problem, offers a solution, and takes that solution to market. Success hinges on being not just the first, but the best or the fastest at delivering value to the customers. Income starts flowing through when customers pay for that solution, but income alone is not enough. Direct costs to produce the solution, the incidental costs for operations, statutory obligations, and financial expenses must all be managed. Over time, companies invest in long-term assets and their values allocated systematically to match their contribution to operations. The financial narratives of these activities is well captured in the profit and loss statement, P&L for short, from gross profit through to EBITDA, down to the net results. The statement provides a clear snapshot of how well the business is performing. That's the balance sheet, a snapshot in time, where the P&L tracks performance over a period. The balance sheet freezes everything at the moment in time. It shows what the company owns in the form of assets, owes, liabilities, and the equity that remains in its business as for the owners. This is the foundational equation that comes into play, where assets equal liabilities plus equity. Every piece of equipment, every outstanding invoice, and every bit of cash is funded by equity. Loans are retained in earnings. This balance sheet reflects how a company manages its resources and grows its equity through accumulated profit. Then comes the cash flow statement, tying the P&L and balance sheet together. This particular statement shows how cash moves in and out of the business across 3 activities. The first one, operating, starting with net income. It adjusts for non-cash items like depreciation and working capital changes. Next up, you have the vesting, which covers expenditures on assets or proceeds from selling them. Then you got finance, and this tracks cash raised through loans or equity and how repayments and dividend affect cash levels. By the end, the cash flow statement gives a complete picture of liquidity, aligning perfectly with the cash on the balance sheet. Now, this is where financial planning and analysis, FP&A, shines. FP&A isn't just about crunching numbers. It's about turning them into actionable strategies through monthly management reviews, annual budgets and quarterly forecasting, long-term plans and scenario analysis, transformation impact reporting, and what-if scenarios. FP&A drives decisions that shape the future of a company. The anatomy of a financial model, the magic behind the numbers. Let's dive into the heart of what makes FP&A tick, the financial model. It's where the magic happens, transforming raw data into meaningful insights. Imagine a nested suite of financial and operational models, each one simulating the real-life flow of inputs through the business process and operational activities. These inputs navigate their way into the principal financial statements, key performance indicators, and accounting ratios. Now, think of it as a dynamic engine powered by granular data, accounting logic, and seamless processing, all culminating in impactful outputs. At its core, every financial model is structured around 4 critical components. You've got the inputs. This is where it all begins. The granular data such as sales volume, operating cost, or headcount feed into the model. These inputs serve as the building blocks for everything that follows. Then processing. Here the data is transformed, applying accounting logic, operational assumptions, and business rules. It is where raw numbers take on a meaning. Then you have the main hub. This is the engine room of the model. It connects inputs and processing to deliver detailed outputs. The hub includes the principal financial statements, profit and loss, balance sheet, and cash flow, and extends to industry relevant key performance indicators and accounting ratios. Outputs. Finally, the model delivers the insight in digestible formats. These outputs range from the monthly management reports to quarterly forecasts, 5-year plans, and scenario analysis. Each report is a user-friendly yet packed actionable detail. Before jumping into the mechanics of these models, I'd like to pause to address a few foundational questions. In the first place, what is a financial model? It is essentially a tool that's a framework that translates a company's operational investments and financial performance into numerical representation. It is the blueprint for decision making. Then the next question, what's a fully integrated model? This is the principal financial statements, the P&L, balance sheet, and cash flow, ensuring that any change in any one automatically cascades through to the others. This interconnectedness is key to accuracy and consistency. Then the next suite of fully integrated financial models. What are these? Think of it as a family of models, each representing a specific area of the business, yet all interconnected. For example, sales model might feed into the revenue forecast, which in turn updates the cash flow and profitability projections. What is a driver business suite? Therefore, this approach focuses on the drivers of performance, those key metrics that directly influence results. By anchoring the model in these drivers, becomes a more dynamic and for real-world scenario. So saved for last, what is finance, business partnering, and investor relations? Here's the thing. At its best, FP&A extends well beyond numbers. It bridges the gap between finance and operations, aligning strategy with execution. It's about fostering collaboration, supporting decision-making, and presenting a compelling narrative to the investors and the stakeholders. Now that we've got that groundwork out of the way, we're now ready to explore the driver-based nested suite of fully integrated financial models. Each step in this journey reveals how the input become insights, how logic transforms data into decisions, and how outputs drive clarity and actions. Let's now take a walk through this together, starting with the very first input model, the permanent employees planning model. Starting here, these are the data sets like you would have for any company. Hopefully yours would have the research name, the department, the company, the job title, annual salaries for the permanent employees. Then you have the one for the temporary employees. Then you have the ones for the recurring revenue, subscription revenue, depends how you swing it. Then you have the ones for all your acquired entities. Then the input for the cost of revenue, transaction-based, overheads, Cashbook, and capital expenditure. And then the model, by using this command button, click it. And just like that, it is going to the data set you saw earlier, taking the relevant fields, putting them in the permanent employees, the temporary employees, the subscription revenue, the subscription cost of revenue, services revenue, transaction-based, overheads, Cashbook, capital expenditure, and launch schedule. And just like that, data copying task completed successfully. Voila, that's it. And now you can see that the model, the input models, temp, subscription revenue, cost of revenue, services revenue, transaction-based, overhead, Cashbook, capital expenditure, launch schedule, and then you have the detailed principal financial statements creating exactly what we have just seen. And this detailed principal financial statement, you have the profit and loss right here, the statement of financial position, cash flow, key performance indicators. And you can see it's over 5 years, 2025, 26, 27, 28, 29. And then here, this is the prior projections, live projections, and then you have the differences. And off the back of that click that we did earlier on, I'm going to now clear the input data and then walk you through step by step as I import the contents into the input models. That way I walk you through the fields like we have. The first input model. Using this command button here, I zoom in just to have a feel for exactly what it does. Import the employee data, hit that, and it is now going to import all of that. And just like that, we now have the employee ID, the resource name, the department, the company, the job title, the line type, the applicable D payment outstanding, the start date, and then the end date. I expand here, come back to the job title. Then we have the annual salaries, the FTE, the daily standard hours, the bonus percentage, the recruitment percent, VAT on recruitment, the line type, applicable day payment outstanding, the start date, end date. Zoom back out a bit, and then I collapse this, and we now have the processed sections being days in 360, monthly basic wages and salaries, monthly bonus accrual, basic salaries and wages and national insurance, bonus accrual, employers' national insurance, benefits, health, etc., pension, recruitment, office equipment depreciation, VAT recruitment and office equipment cost, trade payables, any other cost, staff cost, headcount joiners, headcount leavers, headcount brought forward, total line cost. Now, just to help you understand how the model does any what ifs, here's what's going to happen. We're going to let this person leave the company because this person has been promoted, had a fancy job somewhere else, and the person chooses to leave the company, say on the 30th of June 2025. And then when I hit enter, we observe that every other section has been zeroed out. And that's because in June, we have terminated his employment. If I was to change that to, July, and you see exactly what happens right there. So that is the normalized amount feeding into July. And just like that, that's how the model will do anything. And if you want to increase the salaries or change anything, that is just exactly the same way like you'll do it in your business. Next one is the temporary employees planning. Zoom right in using the same command button, import temporary employees data. Hit that. And just like that, task completed successfully. And here we expand just to quickly walk through employee ID, resource name, the department, the company, the job title, daily rate, FT, VAT on recruitment percent, applicable day payment outstanding, start date, end date. And then here we then have the networking days, the monthly cost, we have the monthly VAT trend, the monthly gross trend, the monthly cash trend, the monthly payables trend, any other cost, staff cost, and then we have the headcount joiners, headcount leavers, headcount brought forward, and then we have the total line cost. And like we saw with the other version, for us to come here, extend this particular contract, change that to 28, hit that, and you see just like that, that's going to update right here. And if I do anything like we saw before, that's exactly what's going to happen. If I come here, change the rates to 1200, hit that, and that's going to update accordingly. And that's how the model uses the exact drivers like you have in your company. Next one up is the subscription revenue. Using the same command button, hit this. It's now going into the repository, speaking to the contract database to return the customer ID, the customer name, revenue stream, company, line description, applicable day sales, outstanding. And before I expand to the line type, I expand here. And then here we can now see the line monthly unit amount, unit quantity, commission payable to the sales team, VAT rate percent, line duration, applicable day sales outstanding, line type, start date, and as a result of the start date and the duration, these would update accordingly, which I'll come back to show you a what if rather quickly. We now have the recognized days in day 360, and then we have the deferred days, we have the monthly recurring revenue, the monthly deferred revenue, the VAT, the gross amount, the cash receipts, the trade debtors, the customer account one, the customer account churn, and the customer account brought forward. So if I come back to here, expand here really quickly, and then we have a duration, just zooming in a bit so that we can have a feel for exactly what we're doing. And then we have the line duration. Instead of 12 months, I'm going to change that to something juicy like a 120. And then by doing that, everything is now updated. If I then collapse that, zoom right in, we now see the recognized days going across. By clicking here, you see the model allows the cell the row in which you are, which is, if I do that, that's exactly what happened. The whole model operates in that same way. So you now see that that has now been updated to reflect exactly what has happened with regards to changing the duration, just like you have with any subscription revenue. Next one up is the subscription cost of revenue. Same thing, using this command button here, it goes into the data set, imports the contents, and we then have the following. We have the supplier ID, the supplier name, cost of revenue stream, company, line description, line unit monthly amount, line unit quantity, VAT rate percentage, line duration, applicable day, payment outstanding, line type, start date, end date. And without repeating exactly what we did before with regards to the what ifs, I just walk you through rather quickly. We have the recognized days, we have the deferred days, we have the monthly recurring cost of revenue, the monthly deferred cost of revenue, VAT amount, gross amount, we have the cash payments, and then we have the trade payables. The next one is the services revenue for those in the professional services. This operates differently. This goes into the permanent employees model, picks out the relevant fields. In this case, it's using the employee ID, the resource name, the department, the company, the project description, the start date, the end date, rate per hour, the applicable days, sales outstanding, hours type, to now generate the networking days, and then client hours in quantity, other hours in quantity, professional development hours in quantity, statutory holiday hours in quantity, and then that gives us the total hours in quantity. Off the back of that, we then do a straightforward maths of what is the rate per hour times the client hours executed, and that then gives us the revenue. You can see here, for those that are only client facing, in this case I've used a technology company that is also delivering managed services, and as a result, those in areas, cost departments like finance and sales do not drive professional services, but those that are client facing, that do have projects that are client facing that generate revenue, they have a realizable rate for every client hour executed, and that is where we then have what drives the professional services revenue, which is exactly what we see up there. And the next input model, that is the transaction based revenue. Using the same, hit that, and transaction based revenue data copying task completed successfully. Zooming in just a bit, you have the customer ID, customer name, revenue stream, the company, the line description, the line monthly unit amount, line unit quantity, margin percentage, VAT rate percentage, applicable days, sales outstanding, line type, effective date. Traveling to our right, we then have the product revenue. Next up, product cost of revenue, VAT amount, gross amount, cash receipts, trade debtors, and then the customer count one. This operates in exactly the same way, whereby if I was to change any of these dates right here, the effective date in this case I'll use, and the model will update accordingly. If I change this to 2026, you see that's going to pop from here onto here, just like that, and it's going to be recognized in the month, and just exactly how you do your business in real life situation. Next one is the overheads. Use this command button here, import the overheads data, done successfully, line ID, supplier, overheads category, effective date. Expand to see the other contents, overheads category, company, line description, net line cost, invoice date, VAT rate percentage, effective start date, effective end date. And then here we then have an expression which returns and looks for the groups that they belong to, and then the expression line description, which is just using something intelligent to return what you want to read out during your presentation. As you're walking through, you collapse here, and then you can now travel to the right to see the recognized days. I always use day 360, and then you have my deferred days, you have the monthly overheads cost, monthly deferred cost, VAT amount, and the gross amount. The next one is the Cashbook. Here, just pause a little bit to read the contents here for the purpose. Types specifies whether the funding is equity or loan. Investment type describes the specific type of funding, such as seed funding, Series A, term loan, etc. Amount indicates the investment amount in local currency. Interest rate denotes the applicable interest rate for loans. Tenor, stroke duration, specifies the duration or tenor of the investment, such as the term length for loans or the funding round for equity investments. For revolving credit lines or convertible notes, specific terms are mentioned. And then using the same gray command button here, it is now going to some repository to retrieve the information, the fields it needs to help with the reference ID, the provider, the debt or equity description, the company, the amount, the effective date, type loan or equity, rate percent, duration in month, repayment type, alternative end date, line description, loan end date. From there, we then have the computation of the recognized days, the cash flow, the cash outflows, the scheduled payments, the scheduled interest, the scheduled principal, and then we end with the closing balances. Next one is the capital expenditure. This doubles up as your fixed asset register. Use the command button here. It now goes to retrieve what we need from the fixed asset register somewhere. Then you have your reference ID, supplier, the asset group, the company, the asset description, the amount, the effective date, including stamp duty, yes or no, alternative end date, the line description, the asset life, calculated days, asset end date. With these fields, we now have what is computing the recognized days, the capex amount, the VAT amount, the monthly depreciation, then the accumulated depreciation, and that gives us the residual net book value. The final one, this is the loan schedule. This one here, you have something that lets you do something like this. You enter the asset value, which is in this example is going to be something as simple as 1 million. And then when you've done that, the deposit is 200. And then once you've done that, you now have something that computes the loan to asset percent, and then using an interest rate of say 5%. And then you have the loan duration, say 20 years. And then once you enter that, then you have the start date of the loan. In this case, I'm going to go 01/01/2025. Hit that. And then you now have what lets you do the following. What's the asset category? In this case, I'm just going to go freehold property. And here, I now expand here. What is the average annual asset change? I just go for something that's easy as 2% for now. And once you've entered all of that, you then have this it gives you the following: the posting month, the standard balance carried down, the period counts, the updated balance brought down, additional payments, changes to interest rates, which I'm coming back to in a second, applied interest rate, updated payments, and so on. These updated payments, the interest payments, the principal, all these updated sections, this is when you now come back here and you now decide, okay, I have a balance of 778,000. You know what? Why don't I just do something as easy as this, 750, 1, 2, 3. And then when I've done that, the model will then update as follows. You can now see the interest as a consequence has now dropped significantly. And then as you go, you now see that you have paid off everything right here. But what would have happened if instead of you just doing that, just copy that, slap that right in there, and you can see exactly everything has now been paid back, and then you have a refund. And just by doing that, you have paid off exactly that. And that's because you paid off the updated balance. But if you were to have done the right thing, which is take this particular figure right here and then drop that right here, and you will now see that you have paid off exactly your loan. And as a result, you have saved every other thing. So let's now connect the inputs to the model of the principal financial statements and key performance indicators. We see data captured in the respective input models generate the output that feed directly into processing the hub, that the detailed principal financial model and key performance indicators, being one I'm going to now walk you through, would help you and I understand. The hub. To have a full appreciation of exactly how this works and what it does, depth of its contents and everything, I'm going to go back to the input models and enter just a one-line entry in one of these, and then return to the detailed principal financial statements and then walk you through. Here I'm just going to put in and then in department I would just pick operation, company, parent company, job title. I just call this annual salary. I use something flat. FT of 1, daily standard hours of 8, bonus percentage of 10, recruitment I just use something 20 here. VAT on recruitment I would use the standard, which is 20%. Line type being another drop down, just call this new hire. Day payment standing I would use 30 days, and then start date for now I would use 01/01/2025. Hit enter, and then that's in place. Go to the temporary employees. I will call this Temp 1, and then the department. In this case, I'll go for network company, parent company, network specialist, daily rate, go for 500, FTE 1, VAT on recruitment 20%, day payment standing, I'll go for 30 days, start date 01/03/2025. Hit enter, and then the subscription revenue, I'll call this customer subscribe, and then revenue stream, cyber support company, parent company. Line description would be, let's learn, monthly unit amount would be 100, line unit quantity would be 10, commission payable for the recruitment would be 5%, VAT rate percentage would be 20, line duration would be 30, DSO would be 30 days, line type would be new customer, and then the start date I would just go for 01/06/2025. Hit enter. Cost of revenue, I'll call this provider. Cost of revenue stream, but before I do that, cyber support company, parent company. Line description would be communication. Monthly unit amount I just go for 50, unit quantity I'll go for 10, VAT percentages I'll go for 20, line duration I'll go for something like 30, 01/01/2025. Hit enter. Services revenue, we'll come back to that. Transaction based cost, and then here we have a revenue stream that is going to be cloud storage company, parent company. Line description, we just call this product, and then line unit amount we just go for 1000, line unit quantity we just go for 10, margin percentage we'll go for 25, VAT would be the standard, and that is going to be 20%, and then the effective date would be 01/06/2025. Hit enter. And then the overheads, we just go for supplier overhead category. Before I do that, advertising company, using the parent company, line description, advertising net line cost, go for 120.13. Invoice date 01/01/2025. VAT percent 20. Effective start date 01/01/2025. And then effective end date, I would go for 31/12/2025. And then on the back of that, we've got everything that we need. Cashbook, I'll just go for owner. Debt or equity, I would go for share capital company. I would go for parent company. Amount, in this case, I would go for 100 for now. Effective date, I will go for 01/01/2025. And I'll go for equity. Right, that's going to be 0. Duration in month, ignore that. Repayment type, ignore that. And then alternative end date will be that. And in light of that, we then have a capex. We'll just call this IT. Asset group would be IT equipment. Company would be parent company. And then we just call this tech equipment. And then the amount would be something like 25/123. Or just use something that is easy on the I-24/123. And then the effective date would be 01/01/2025. Does it include stamp duty? No. So off the back of that input, we then have the model return the following for us. We have something for the profit and loss statement, something for the statement of financial position, something for the cash flow, and something for the key performance indicators. And where you have the subscription count, the average revenue per unit, cash and cash equivalent, giving us the financial runway where we compare that against our total operating expenses. What we see now is the position as follows over 5 years. We have this section here which readily creates our annual budgets because it's over the next 12 months. And if we click here, we can then expand to see the revenue streams. You can drill down further by one more click, and you can see the data that we entered for the cloud storage showing in June 2025. I go back to here, which is where we have the transaction-based revenue. If I change that to September, and then go back to the detailed principal financial statement, we see that that has now moved to the month of September. If I go to the subscription and we were to do any of the following whereby I'm going to change this month and I'm going to change the units, subscription revenue, change the month to March, and then I change the units to 15, go back to here, and we see exactly what has transpired. What is even better yet is where we now have the chance to see how the transformation impact reporting exactly works. And that is done by, I move all the contents from here onto here, and that's now done. We can now come back to here. This is what we had before. If I take the contents and I just replicate that, hit that right into them, and then I change the departments or cost centers. And then by doing that, and then come here, change this to say 100, 1, 2, 3, and then change this to say 90,000. And I switch this around to any months of my choosing, and I do the same here. And then by the time I've done that, what will now happen is that when I come back to here, I now have a situation where I can now take a look at my live projections against what I had in mind before, against the live projections, and you can see exactly what has happened with regards to the product revenue staying the same, the subscription revenue staying like that. But just to give it a feel, go back to the subscription revenue, and then this time I would do the same thing, just take the contents and then drop that right into here, and then revenue streams like we did, CRM software, take that one, web hosting, and then go back to the model, and we can now see exactly what we had before versus what we now have, and exactly the differences where they're emanating. And that's just how the model gives you that level of accuracy and confidence, just by using the exact drivers like you have. So just quickly walk you through. We have the total revenue here. We have the total revenue. We have these by the gross product cost of revenue, subscription, giving you the total non-personnel cost of revenue. Traveling down, we then have the various for the personnel cost of revenue. These are the ones that are client facing for professional services, and you can expand further to see the line by line cost based on the inputs that you have entered in here. And with regards to this particular department of cost centers, we have the wages, employers' national insurance, bonus percentage, bonus commission overtime, employers' national insurance, vacation pay provision, employers' pension contribution and benefits, travel, staff cost, other staff costs that are professional, and then the recruitment cost, all by just simply entering the inputs that you would have in your human resources information system. And just to showcase the one for the operations, I come back to here, and if I now take this line here, and I'm going to do something that operates as follows: hit that, hit this, change this salary to something juicy, give this 200, 1, 2, 3, enter that, and make that end 30th 5. Then when I've done that, come to here, do something like this plus 1, and that is because we have this person here, and we are going to not call this new hire, but we're just going to call this role change or other. It doesn't really matter. But for the walkthrough here, and then by the time I've done that, go back to the model, and we are now going to say the following. We can now see that the salary has changed, and we can see that the employer's national insurance, the whole thing, everything has changed accordingly. And that's because of what we did with regards to where we were before and where we have now changed it to. So that's what has transformed. And as we go down, every other department or cost center is expandable to give you exactly the line by line, same layout with regards to what you have for the people cost. And then we travel down, we then have total people cost right here. And then we have the promotional marketing expense, which you recall was what we entered for the overheads. That's exactly that. And you can expand to see exactly the line. And total operating cost is consequentially what we see right there. And then the operating income or loss is there for that. And as we travel down, we see that the company year on year is a loss-making one because the generated income is not over and above what the total operating expenses are. And for the company to be able to do that, it can increase the revenue units, increase the prices, the timing and everything. But just to have a different appreciation, we are now going to go. Before now, we had just the capital introduction of £100, and the company over the next 5 years, it is reporting that it needs 314,726, which is something that's reflected in the cash flow movements. Go back to the Cashbook. In this case, I take that figure, copy that, go back to the Cashbook, and then I'm just going to call this cash injection, and this is going to come in the form of for the share capital. But just before I do that, let's just make this any loan and say it's a revolver, and this comes from the parent company. And by the time I take that figure, which was argument's sake 353, and I do that, and effective date 01/01/2026, and I call it a loan, and then say it's got the cost of financing of 5%, and then we got a duration of say 24 months, and we have principal and interest repayments, and then there's no alternative end date. By the time I go back, you recall it was 300 and something thousand, and when I come back here, we see that we had the cash coming into the organization right here, and we need to expand to see that. Right here, which is the net of the principal repayment. However, because of the interest that has been layered on top of that, we still find the company actually more or less in the same situation, which is where when we run up to the P&L section, we have the following. You then see the financing cost right there. And because of that, the company has yet gotten that injection of 350,000. However, it has not gotten itself into a better situation, whereby if you go back to here, and instead of making this, you choose to make this share capital, and you introduce this in January of 2025, make it equity. There is no cost of financing, and you remove that, and then you ensure there's no repayment. And then when you do that, go back to the model, and you can now see, lo and behold, the company is now in a better position, equity, net assets, the whole 9 yards. And you can go to the executive overview and have a view that looks as follows, but this is going to be best viewed from the transformation impact reports. This is where this really comes to its own. You then condense, and you can see the profit and loss looking as follows. The balance sheet looks as follows. This is the pre-transformation, this is the impact year on year, and this is year-to-year changes, and then this is the post-transformation. So you can now see where you were pre-transformation, and you can see your post-transformation returning as follows right there. And you can see your cash flow, and you can see your key performance indicators, and you can see your services hours, and you have everything with regards to your revenue per resource, your total cost per resource, the contribution per resource, and then you have your subscription, and you have your financial runway, which now tells you pre-transformation, this was your dire situation. Post-transformation, this is your desired outcome. That is how this detailed principal financial statement loaded and expandable month-on-month view gives you the level of granularity that you choose and desire to see how you want to view them to help you understand exactly what's going on in your business. Now, from that detailed walkthrough, I'm now going to show the condensed format of the detailed principal financial statements and key performance indicators that tie together the financial and the operational ecosystem, feeding up the financial business partnering sessions that routinely culminate into the condensed narratives and products of the distributable management reporting packages. Here we have the executive overview, that's profit and loss, balance sheet, cash flow statement, key performance indicators, and then we have service hours analysis here, and then we have the recurring revenue analysis, client hours analysis, then we have the subscription recurring revenue, and then gives you the average revenue per unit, cash versus the expenses, where you have cash and cash equivalent compared to the total operating expenses to give you the financial runway. Next up, you have the P&L, drill down, expand as desired, top line, total revenue, non-personnel cost of revenue, people cost, non-permanent resources, promotional occupancy, professional statutory, EBITDA, and then you have your total operating expenses right here, depreciation and amortization, and then you have your extraordinary costs, and then you have your interest paid or received, you have your tax, headcounts, services hours, whole 9 yards. You have your client hours, subscription count, and then you have your cash versus your operating expenses. Next one, you have your balance sheet, and you can see your net book value of your long-term investments, and then you have your current assets, you have your current liabilities, and you have your long-term liabilities and debt, and you have your net assets, the maths between your total assets less your liabilities, and you have your shareholders funds, leading you neatly to your total equity. You have the same attention grabbing where you have your cash and operating expenses telling you your financial runway in months. And then you have current ratio, working capital, liquidity, return on assets, net gearing, debt to equity ratio, return on equity. Next up, you have your cash flow statement, net working capital movement, giving you your operating activities cash flow, investing activities, and then you have your long-term debt, and then you have your equity, and all of that give you your financing activities, net cash flow, opening cash, cash movement, closing cash. Following from that, you then go to the next one, which is your key performance indicators, starting with the profitability ratio, liquidity ratio, activity ratio, debt ratio, customer ratio, professional services ratio, general business metrics, departmental headcount closing. Next one up, you have your transformation impact report. Here you're looking at post-transformation, pre-transformation, impact year-on-year percentage. And then here you have your profit and loss, your balance sheet, and you have your cash flow statement, key performance indicators, services hours, subscription, and your cash runway. The next view of the transformation impact report, you're looking at pre-transformation, impact year-to-year percentage changes, and then your post-transformation outlook. And then you wrap it up with your departmental P&L. And this is where you can do something as easy as this. Just pick the department you want to view, and it will go and retrieve all of that. And you can generate any one for any of the departmental heads. And this is something you can now ship off to the departmental head lead for them to have that particular session for the finance business partnering. And we saw that a transformation impact report. This is a very, very important report because it's a comprehensive document that evaluates the effects of significant changes or transformation within an organization, project, or policy. It typically includes an analysis of the outcomes, both positive and negative, an assessment of how these changes have impacted various stakeholders, processes, and overall performance. The report aims to provide insights and recommendations for future improvements and to ensure that the transformation aligns with the organizational goals and values. This report evaluates and returns the strategic changes and their financial implications across the P&L, balance sheet, and cash flow, as well as the key performance indicators. So here's where I would like to now connect all of this to an FP&A, because we have witnessed that a management reporting package is a comprehensive set of reports and tools used by organizations to monitor and manage their financial and operational performance. This typically includes financial statements, budget reports, variance analysis, and other key performance indicators. The management reporting package helps management make informed decisions, track progress towards goal, and ensure accountability. The management report package plays a crucial role in any organization by doing some of the following: providing the insight they so need. It offers detailed insights into financial health, operational efficiency, and overall performance. It further facilitates decision making because the managers use the same management report to make data-driven decisions, allocate resources effectively, and adjust strategies as needed. Enhances communication by serving as that communication tool between departments, ensuring that everybody is well aligned with the organizational goals and objectives. All in all, a well-structured MRP, especially a driver-based one, is essential for effective management, improved decision-making, and maintaining strong investor relationship. These now form the characteristics of my methodology that includes some of the following. Number one, simulation of real-life situation like you find in companies, whilst being very mindful of the uniqueness of the company's operations, making the cost and revenue just flow through the model by using the exact same activity drivers as you have in your actual. And these are always bottom-up models that use the start and end dates as their triggers. Then you saw that there was a clear segregation of the input tabs from the output tabs. Furthermore, within the same input tabs, you saw that I also confined the input cells in an area away from the output and the calculated section. Full integrated principal financial statements that include carefully interwoven P&L, balance sheet, and cash flow that do not require a plug-in number. And then you saw there was clear quantification of the units of measure and the financials. What kind of clients? Here's the thing. No doubt not every company works this way, nor needs a model that adapts the actual business drivers as inputs into the models they use. In addition, some companies do not need the financial navigation tool, nor experienced personnel manning their FP&A team. A profile fit and something else may suffice. However, I've come to recognize that some sort of companies that I work with are the ones that include some of the following. Companies who wanted to do accounting and FP&A differently. Companies who ended up with the comment, I never thought about doing it that way. Companies who wanted us to be part of their team, yet free of the shackles of the employer-employee relationship. Companies who wanted to have a finance department or a partner who would challenge them constructively when necessary. And then companies who always wanted support at every part of the process. Companies who also wanted to embrace the driver-based approach to FP&A. My professional accounting qualification has always dictated the ways my model are designed and developed by sticking to the foundation based on the double entry accounting principle. Therefore, highly inconceivable that a balance sheet and a cash flow statement should need a plug-in number to balance. So just to bring this one home slowly, this latest version of my fully integrated nested suite of financial and operational models for performance planning and reporting offers a tailored solution for business seeking clarity and control over their financial and operational planning. This particular model, driven by the same core input drivers applicable across industries, delivers a streamlined yet robust approach to accurate, corroborated, and dynamic financial planning. Here's how we can make this transformative tool available to you. I will encourage you to request a no obligation version of the model that will be a fully functional version, being a financial model specifically designed for your company, and guess what, using your unique data and business drivers. When you request a copy, I would not just provide a generic tool. Instead, I'll populate the input sections with your company's data, tailoring the model to reflect your operational and strategic goals. The custom version serves as a foundation for you to have the following. You're going to gain clear view of your financial and operational landscape. You're going to drive efficiency by optimizing cost, vet your revenue projections, and capitalize on growth opportunities. Guess what? no obligation demonstration walkthrough. And to ensure you maximize the benefit, I'll walk you through the model myself, a detailed no obligation presentation during this session. You will see firsthand how your specific business drivers and data integrate seamlessly into the model, providing a complete view of both your past performance and your medium-term projections. Dynamic and interconnected principal financial statements, operational metrics, and highlighting your key performance indicators and areas. You have the immediate insight into the financial and operational impact of your past decisions, current initiatives, and future strategy. Now, let me address a key concern you may have with regards to your data transformation. If you worry that your data is in perfect shape, don't be. With advanced tools like Power Query, I will be having that opportunity to showcase how easily you can take your raw data, get it cleansed, organized, and transformed into ready-to-use inputs. This demonstration not only highlights the model's flexibility, but also shows the power of technology in simplifying complex data sets. You will also experience firsthand how your raw data can evolve into actionable insight. What you will therefore receive from me when you partner with me, you're not just getting a model. You are gaining comprehensive financial toolkit designed to grow with your business. And here's what's going to be included. You will see and receive the management reporting package that you just saw. You will have your annual budget for your next financial year. You have a comprehensive 5-year plan aligned with your strategic vision. And the best part, it's yours to keep. Your business, your data, your model, purpose-built to support your growth and decision-making for years to come. All you've got to do at this point is just take the first step, and that's all left for you to do at this stage. So you can do both of us a favor by just reaching out today, and I'll be delighted to craft a bespoke version of this financial model that elevates your financial planning and analysis without making further dent to your cash flow station. By way of introduction, I'm Hamilton Aloge, an ACCA qualified accountant with decades of experience in financial performance management reporting, which facilitates my provision of FP&A as a service. By leveraging my commercial exposure, insider business knowledge, leadership in FP&A, and advanced financial modeling skills, I specialize in creation of bottom-up fully integrated dynamic financial models like the one I just walked you through that are deeply rooted in understanding the core activities and data driving your business. This approach enables seamless business partnering with both internal and external stakeholders, forming the foundation of my FP&A delivery. It also allows me to consistently provide a streamlined, complete accounting and FP&A solution, serving as the cornerstone of any simplified financial planning and analysis. If your company has its arms around all aspects of your FP&A, be it tools, processes, and resources, then good on you, more power to you. However, if there are gaps in your FP&A setup, or you believe that your existing FP&A could benefit from experienced support, you might be looking for someone to seamlessly integrate into your FP&A environment and deliver immediate results, or perhaps, you know what? You need specialized expertise in project-specific areas such as financial modeling. If so, then do both of us a favor by using the contact details provided to reach out for an exploratory demonstration. This will involve using your data to create a fully functional nested suite of fully integrated financial models. My hands-on approach to FP&A seamlessly combines all key layers of expertise: financial modeler, management accountant, senior finance business partner, and head director or VP of FP&A into a single streamlined service. Whether it is building FP&A from scratch, fine-tuning an existing FP&A, filling critical gaps in FP&A, or delivering specialized project-specific solution like designing, developing, or enhancing driver-based financial models, I've got you covered. These services are offered on a flexible basis, daily rate, fixed-term contract, or a retainer. This solution integrates financial accounting, advanced financial modeling, strategic insights, and leadership-level reporting and planning, all tailored to your organizational unique needs. For now, thanks for watching. Until the very next time, happy financial planning and analyzing your companies. Thank you very much.